The New Jersey Bank Marketing Association presents its Forecast 2013 seminar. This program was recorded December 6, 2012, in Clark, New Jersey. In this program, Kevin Cummings, President and CEO of Investor Savings, offers his outlook on 2013. At the lectern to introduce the program is Dennis Kane, Marketing Director of Amboy Bank.
Good morning, everyone. My name is Dennis Kane, and I'm delighted to welcome everybody here on behalf of the New Jersey Bank Marketing Association. We apologize for starting late. We didn't have any sound, and we're still trying to work through the sound. Normally, we wait until everybody gets here, but I guess the parkway traffic has cleared. Well, welcome to our 24th annual forecast meeting. In 1988, when our committee was formed, someone suggested that we ask experts to share with us their thoughts on new regulation, new bank products, the New Jersey and the economy. Pretty good idea. 1988 was a very interesting year. Our speakers told us to expect more regulation. I guess they knew what they were doing there. Marketers to develop new, exciting bank for our consumers. They said would consolidate. Look back at notes, some of the bankers that were with us were from Atlantic, United Jersey, Howard Savings, Sovereign, First Union, First National State. I guess they got that one right. Hotel speaker systems would be improved, they said. So with no feedback. I see that in my notes. For the past 24 years, we've been very lucky to have the people who have addressed our meetings. We've had bank presidents, 2 New Jersey governors, a U.S. congresswoman, New Jersey banking commissioners, editors, leading economists address our meetings. To provide marketing support, we need to know more than just marketing. We need to understand banking and the economy to truly support our banks. As we can see from the attendance today, apparently everyone here agrees the importance of learning from our leaders, both in banking and finance. Today we're very fortunate to continue our rich tradition, and we have outstanding speakers that will share with us their thoughts and insights. Jane Gore, who's been on our committee for quite a while, what happens if you don't show up for a meeting, you get named to be chairing the program committee. Jane, I think this is the 18th annual forecast meeting that you've been chairing. And although you've done it right every time, she just keeps coming back and making it better. I'd like to introduce Jane Gore, who will introduce our speakers. Thank you, Jane.
Good morning. I want to thank all of you for taking time out of your busy day to come, and our speakers. You're what is making it better every year, so thank you. Today I'm going to introduce first Kevin Cummings, President and CEO of Investors. Kevin has been President and Chief Executive Officer of Investors Bank since 2008. Prior to joining the bank in 2003, he was an audit partner in the financial services practice in the New York office of KPMG. Kevin worked in the New Jersey Bank community practice for 20 years. Kevin defines leadership as service to others. I don't know if that's what he's going to talk about today, but I found it very interesting. And the key to leadership is communicating the vision of where you want the organization to go. People want to be part of the team and to live a purposeful life. He encourages all employees to become leaders of nonprofit and community organizations. And Kevin says that each morning there's a huddle in each branch to get everyone energized about their work. This is day-to-day management, creating a purpose, a culture where people take pride in what they do. He tells managers, and I heard this from my mom, people do what they see, not what they hear. Wasn't it sort of like, always do what I tell you, don't do it? You have to lead by example. And this is what has led Kevin's near doubling of the bank's assets to about $11 billion. Please help me welcome Kevin. Thank you.
And good morning. It's good to see so many familiar faces here. This is my 3rd time speaking here. 2008, 2010, so I'm an even year person. Even keel. And really, I think what I'm going to talk about a little bit today, we have Jim here, a noted New Jersey's most noted economist, and my good friend Chris. I'm going to talk a couple different things. I'm going to talk a little bit about investors and what has happened at Investors over the last couple of years. When I had black hair, when I joined it, and then we're going to talk a little bit about the economy and a little bit about Sandy and the impact that Sandy will have and has on things going on in New Jersey economy. With the election, I don't know. I'm a Hudson County guy, registered Democrat, never voted for Reagan, but I was disappointed with the results of the election because I think we need a businessman, to turn this country around. Too many politicians in Washington and not enough public servants. We talk about service to others, and I think people are too concerned with, the election cycle every 2 years. So a lot of things, I'm not too optimistic. Matter of fact, this past weekend, I was out to dinner, and my suggestion was, after a couple glasses of wine, was let's move to Texas and secede from the Union, So, but my wife looked at me sideways because she doesn't like the summers in Texas. And then I'm going to talk a little bit about what New Jersey Bankers is doing in my role as chairman of New Jersey Bankers. But, when we joined Investors back in 2003, it was really a great place to work. And it still is a great place to work, but the definition of work has changed over the years. And it's something that I don't say anymore around Investors, but when I first got there, I used to say it a lot. I want to bring the CPA work ethic to Investors, because being a mutual and having approximately 80% of its assets in mortgage-backed securities. It's a $5.2 billion shop with a $4.5 billion security portfolio, $700 million loan portfolio. And there wasn't much to do. And people would, come in, they'd check out the bond portfolio, not much going on the loan side, and it was just a residential portfolio. But my predecessor's predecessor, who was a CPA, a former Pete Marwick guy, Matt Raftery, he expanded the retail network. So here it is. He realized what was going on, and he started a mortgage company. So he saw the problems that were there, and with just having a securities portfolio. It was a hedge fund, a fixed income hedge fund, and he started the process of the change. But unfortunately, he passed away in 2002, and Bob Cashel joined the bank, was on the board, came off the board, and became the CEO. And after getting beaten up by the regulators for interest rate risk, he said, "We got to change." And in 2003, we put a business plan together and started the change. And the business plan was your normal business plan. It was a lot of graphs, peer analysis. And when you looked at the peer analysis, it wasn't pretty. We were at the bottom 25% in most of the metrics. And the metrics that we use to drive the company, today, and the ones that we picked back then was return on equity, efficiency ratio, and asset quality. And of course, the asset quality was outstanding because most of the investments were in agency securities, federal agencies, Ginnie Mae, Freddie Mac, and Fannie Mae. So, but that was the easy part, figuring out, all right, we're going to change. The more difficult, the how and the what are always easy to figure out to do. All right? The best thing is, I never want to be the smartest guy in the room. You always want to be around people smarter than you, and hopefully be a good teammate and help other people be successful. So the how and the what, that was the easy part. We figured we'd take the cash flows of the securities portfolio, have no growth, right, because we didn't have a lot of capital, and then move it along into residential loans, safe assets, no problems. And that was the initial step. When Provident bought First Sentinel in 2004, 2005 timeline, Rich Spangler, our chief lending officer, became available to us. Well, when he joined, we started a commercial real estate business. And the good thing about getting that up and running probably in 2006, 2007, was we started construction lending in 2006 to 2007. The bad thing was we started in 2006, 2007. And when you look and see what we accomplished over that time, Rich brought a team in. He created a business. He had a lot of knowledge about the business, but more importantly, he had a lot of contacts because he grew up in the commercial real estate. So that was our first foray, moving the business from a thrift to a full-service community bank. But again, that's the how and the what. The hard part was changing the why and changing the culture of the organization. And doing it in a way that, my good, serving others was, with respect to the employees, that many of whom were, 20, 25 years employees at the organization. We were a 42-branch organization. A typical branch manager never knew what a chamber meeting was. If they got home by 5 o'clock and was home for dinner every day, it was a beautiful thing. Of those 42 branch managers, now that we're 103 branches, only 15 to 17 remain in the same position. But we never had a mass layoff or a RIF program. So here it was, we had to make investments in the business, make investments in the in training, make investments in the infrastructure and the risk management, the credit areas. 2007, all right, we're off and running. Well, back in 2005, we had the opportunity to do our initial IPO. And that gave us the capital to grow. But in that time period, 2006, 2007, we had a flat yield curve. So, my predecessor, Bob Cashel, said, let's hold still. We can't grow. And actually, in 2007, we were a $5.7 billion bank. We made $11 million. And then there was, we changed management. We came in, Dominic, our COO, moved up from CFO, and we said, we just can't stand still. You just can't stand still. Because our view is, if you're not getting better and improving, you're getting worse. It's like a relationship, with your spouse or significant other. If it's not getting better, you're working on it every day, it's getting worse. I talk to my kids and they say, Dad, I'm like, why, how'd you get along with Mom for so long, for 31 years? What's going on here? And I said, it's work. You guys, I have to love you. You're part of me, right? I just, I have no choice. But with your mother, I got to work at it, And that's what it is. And that's the day-to-day. Like when I talk to the analysts at KPW or some of the other Sandler O'Neill and things like that, it's like talking to sometimes politicians. They've never, very rarely, have they run a business. It's like when I was an auditor. I was in the business of accounting, the business of being a CPA. We were running a business. We had profit centers. You're running a business. When I was out talking to the customers, I had to learn their business. But when you talk to the analysts sometimes, they're worried about their models. But the day-to-day management of what we're trying to accomplish, of getting that 24-year-old teller to give ordinary service, not to give ordinary service, to make every customer contact extraordinary. That's the real challenge. And that's what we're trying to create there. And in the introduction, when you talk about empowering those employees and getting them fired up every day to make the ordinary extraordinary. Well, we say at the bank, we want to create the Disney Ritz-Carlton of banking. And I can get up here and say it every day, but if you don't empower people and change the culture, change what's here, you're never going to get it done. And that, with banks our size, that's where the competitive advantage comes in. There are 111 banks headquartered in New Jersey. All of us can do a great job. New Jersey is the best place to be, in business and banking. Andy Senchek from KPW came in when we were looking at a bank, actually the one that Provident bought, First Morris, and we were talking about it and going back and forth about the pricing and this and that. And we were anxious to leverage our capital. We just did the IPO in 2005. We had 17% capital. First Morris was available. And Andy said, well, you got to leverage the capital. The capital's like a magnet. It's going to attract things. So after the discussion, he left, and on his way out the door, he says, well, Kevin, don't worry about it if you don't do this deal. He goes, you're in New Jersey. He goes, if you do good, you're going to do very well. If you don't do good, you're still going to do okay. because New Jersey is a great place to do business. So when you look at it, in 2007 comes along, and you talk about your first meeting here in 1988. I made partner in 1989 at KPMG. The economy went in the tank. Hudson City failed, City Federal failed. I made partner made CEO, promoted to CEO in 2008. Citibank fails, Wachovia fails, Bear Stearns fails. So the next job or promotion I get, short the stock wherever I'm at. Okay? So really, when you think of then what's happened here, here in New Jersey, people stopped lending in 2008, 2009. We had a ton of capital, and it was an unbelievable opportunity for us. All right, we were about $5.7 billion. Since then, we've done 6 acquisitions. I would say all of the acquisitions had stories with them. The first one was a mutual that we paid nothing for. The second one was a troubled bank in a Banco Popular, a purchase of 7 branches. Banco Popular had problems in Puerto Rico. American Bank was a thrift that 3 years and a day after its IPO was for sale. And then Millennium Bank in Newark had problems. And Brooklyn Federal was under a C&D. And then just recently we completed a $900 million Greek bank, Marathon Bank, that the parent company sold its best asset. All right, and that's the only one where we feel we paid a little more than we wanted to. So when you look at those 6 acquisitions, $5.7 billion in 2007. Today, we're $12.5 billion. Going from 5.7 to 12.5 billion over those 4+ years, almost 5 years. 60% of our growth has been organic. 40% is through acquisition. But the best part about the acquisition story is our deposits, our core deposits at those acquired entities, are up in the range of 30 to 40%. So we've taken underperforming franchises and expanded them and put our sweat equity in without paying a high premium as a result of the acquisition, keeping the term goodwill off the financials. When you look at the organic growth, after creating our commercial real estate group in 2006 and 2007, the construction portfolio was about 7% of loans at the end of 2007. We had a $4 billion portfolio, of which 90% was residential, 10% was commercial. Of that commercial, 250 million was in construction. Now you know why I'm going bald, all right? Of that 250 million, we probably took 75 million in charge-offs, all right? Now, but we didn't stop lending. Why? Because we had the capital, all right? We were, in 2007, 2006, a $5 billion bank that acted like a $500 million bank. The level of borrowers that we took, like if you had a piece of land in Union City and you owned the building, not even you owned it, you didn't even own it, you inherited it from your grandfather, and you hooked up with a lawyer, all of a sudden you were a condo developer, and we were financing those types of loans. And when the when the economy went south, when things hit the fan, who were the first guys to go? Those inexperienced developers that didn't have the staying power. All right. So when you look at those types of credits, they're the ones we took the baths on. It was in that for sale property, condo, townhouse. Maybe the empty nester was going to move up from his house in Bergen County, moved out to Morris County, or to a retirement community. In that 800,000 to $1.5 million, that's probably selling now for $650. That type of townhome and development project, we took some terrible hits on, but we learned a lesson. And in that lesson, we decided, we had a $44 million multifamily portfolio, and we decided to move and change the direction of the organization. We opened up a loan production office in 2010 in New York City, and today we have a multifamily portfolio of about $2.5 billion. with minimal, less than 50 basis points delinquencies. It's a great asset class because why? Why is it a great asset class? Well, when you look at the delinquencies, you have a residential loan, you have to worry about one divorce, one person losing a job. You look at a multifamily loan, it's 10, 15, 20 unit building, 2 or 3 people lose their jobs or get divorced, you still have enough cash flow to keep the thing going. So making that change, we were a $4 billion portfolio, 6.5% construction. Today, it's a $10 billion portfolio. 50% of that portfolio now is commercial. Of that 50% is multifamily, about $2.5 billion, with a great asset class. So that was a strategic, directional change of the organization because of what was happening in the economy. And during that time, now we're talking about, slowing it down because of the interest rate environment. 5-year stuff is under 4% right now. I had a customer just recently come up to me and had a 5-year CD mature. And he was asking for a 2.5%, roll it over for 5 years, 2.5%. I said, well, that's impossible. If you can get that somewhere, I'll drive you to the bank and I'll open up an account with you, all right? So really, when you look at it, dealing with the interest rate risk and some of the issues going on there is like the next thing that's a concern for us. But when you look at it, I think our prospects right now are very positive, because when we did our IPO in 2005, we only sold 45% of the company. We have what we call the second step opportunity, and we've set out some parameters for that second step opportunity. One was, leveraging the capital that we raised in 2005, getting our capital down from 15%, 16%, down to 8%, under 8%. Technically, right now, we're under 8% on leveraged capital. Also, a 10% return on equity and paying a dividend. And the last 2 quarters, we had a 10% return on tangible equity, and we started paying a dividend November 1st. So I think the second step is on the horizon for us. It's going to be a $1 to $1.3 billion capital raise, and if an opportunity came up with another potential merger with an MHC or something, we would probably delay it a quarter and try to do a transaction if one came available. I think it's almost like you run the business with your eye on the economy, but you run the business, you can't stand still. And even in a bad economy and a good economy, Warren Buffett has been an investor in the American economy for over 40 years. He's done pretty well. So the way we look at it, and I'm not saying we're Warren Buffett or anything like that, but whenever the stocks are being sold, someone's buying. And in that, we were making our best loans in 2008, 2009, because there was less competition. During that period, we were making 6% loans in an 8% cap environment. Now, we're making 4% loans in a 6% cap environment. So what would you rather have? And with where interest rates are, our spread went from below 2% net interest margin to 345 over that period of time. And it's not a $500 million bank. It's a multi-billion-dollar organization. So a lot of it was luck. A lot of it might have been just being a youth, being a youthful enthusiasm when we came in 2008. But a lot of it is the energy that our employees have, and the sense, the best compliment we can get is we don't act like a banker. We're out there trying to act like owners, being entrepreneurs, and trying to make a difference. And my job is to make a difference, first and foremost, with our employees. And our employees' job is to, first and foremost, make a difference with our customers. And hopefully, they'll form that partnership, and together, they'll serve, the communities. And if you take care of those 3 things, our shareholders will be happy. And if our shareholders are happy, hopefully I'll keep my job. So that's a good thing. So now I'm going to shift gears a little bit. I just wanted to give you an overview of where we were and what's been going on. And because I get asked questions once in a while, like, did you really think about it in 2008 and 2009? And I was responding to an investor at an investor meeting, and I said, no, we didn't think about it. I told him the story. I said I felt like Tom Hanks on the beach with Saving Private Ryan. I said, let's not stand still. We're going to get slaughtered here. Let's run up to the cliffs and start, throwing the ropes up and get up the cliff. And that's what it was in 2008 and 2009. You had to do something. Sometimes, and my father once told me this, sometimes, and I don't live by this, but sometimes a bad decision is better than no decision. Be decisive, make the changes, and move on. And don't think about it. So the economy. I tell you, what can you say about the economy in the last 3 years? Unemployment has remained high. The labor market has failed to improve. And basically, it's going to be more of the same. I guess it was the guy from PIMCO, Mohammed, I forget his last name, he says it's the new normal. And I think when you look at things, the new normal is here. And I think a lot of it is being driven by demographics, with the baby boomers going through the retirement cycle. They're no longer the consumers they were in the 80s and the 90s. And it's a very, very difficult time. This 2% growth rate, plus with the uncertainty of the the fiscal cliff, or more importantly, the fact that government doesn't run its businesses, and even a lot of the not-for-profits I get involved with, they just don't run their businesses. This could be colleges or hospitals. They don't run their business like a business. I mean, if we ran our banks the way, or our marketing businesses, our PR businesses, the way government runs theirs, we'd be in a lot of trouble. So I think, if you look at the unemployment, we've had a sustained period of above trend growth. The pace of new job creations has been extremely sluggish. Through the middle part of this year, there were 4.7 million fewer jobs in the U.S. compared with 2008. The percentage of working age adults that are employed has stagnated around 58%. How many people, I have a brother and a brother-in-law that have been laid off from major corporations, one AT&T, one IBM. When my brother left AT&T, he was hired back as a consultant for 10 years. He made more money as a consultant because he worked with a customer as a consultant and AT&T. Traveled all around the world. Well, AT&T gets acquired, that gig is over now. My other brother-in-law up in Connecticut, a career IBM, 32 plus years with IBM, got laid off in their finance department, got hired back as a consultant with no benefits. All right, that's happening all over the place. All right, so the jobs and the workforce is shrinking. Real personal incomes, excluding government transfer payments, remains 1.5% below the pre-recession levels. And despite the enormous level of government support, where the last 3 years, 1.3 trillion has been the average deficit coming out of Washington. It's 1.3 trillion. I read something in the Wall Street Journal this week. The amount of debt, the 16 trillion that they're always talking about, the amount of debt that has been put on the books since the second year or the first year of Bush II, George W., is more than all of the debt since George Washington to that time. So in the last 9 years or 10 years, our debt is more than the the history of the country, and it's just unsustainable. There's fewer workers in the workforce versus the baby boomers, and there's just not enough people paying the bills. The 47%, I guess, I don't know. But then you look at some of the other things that we're facing. The European debt crisis remains a formidable threat to our economy. I think, what's the term? Extend and pretend. They kick into things down the road. We don't see any real strong reforms. If you look at what they call the pigs, Portugal, Ireland, Italy, Greece, and Spain, unemployment's over 20% in those countries, it's a time bomb ticking. What politician is going to really be committed to austerity? And how long are the Germans going to stay there and continue to support it? You know, the problems in Europe because of the exports impact what our growth potential in the U.S., as exports have been about 10% of our growth in GDP in 2012. And also, just the news, you know, it impacts consumer confidence, and it just doesn't make things, you know, manageable. The bright spot, and I don't know how sustainable this is that, you know, consumer spending, you know, bolstered by the baby boomers, you know, continues to carry the economy. I mean, traditionally in GDP, if we're looking at, you know, 2% GDP growth from 1983 to 2007, GDP growth averaged about 3.31%. But if you look at the how much of that was the consumer, it's been consistently that 70 to 80% coming from the consumer. Is that sustainable over the period of time? And that's why consumer confidence is so important, especially as we get into the holiday season. You know, if we look at some of the positive factors, I think, you know, affecting us, again, consumer spending remains the largest driver of the economy. Moderate job growth should support annual gains of around 2% in household incomes and consumption, along with a sustainable savings rate of 4.5% to 5%. Business investment has also been a consistent source of strength in this recovery. We're seeing domestic, not necessarily here in New Jersey, but manufacturing and industrial production, which enhances, companies have been enhancing productivity via equipment and technology investments, and that remains a key priority of many companies. We have to be more efficient. And then also we have Chairman Bernanke, you know, and you know, he comes under a lot of criticism, you know, and maybe, I really don't know. I mean, everyone thought his predecessor was the guru, but I mean, his image and historical references has changed certainly over the last couple of years. But I look at him and I see him as a courageous person because he's really stepped out there. And I look at him and I wish our government down in Washington would do more of the same. He's drawn a line in the sand. And he's done, I think he's been one of the most courageous guys. You know, I admire what he's done. I don't know, I don't have a clue if it's right. I think he's rolling the dice as far as the long-term viability of the economy. But certainly, he's doing something. And he's doing it in a nonpartisan way, and he's showing courage and leadership. And, you know, when I think of what he's doing and what he's trying to accomplish, I think of Sean Connery in the movie Untouchables, when he said, I'm bringing he said to the gangster, typical gangster, you know, you're bringing a knife to a gunfight. I mean, he's fighting this fight without any fiscal policy help. If anything, he's holding the economy up with the monetary policy. So I think, you know, I applaud what he's doing. Longer term, though, I think we're going to pay for it eventually. Just imagine, $16 trillion in debt, and interest rates go up 3%. That's $500 billion of interest payments that the government's going to have to pay China. And when you know, I know he got criticized for it, but when you think of when Romney in the first debate said, I don't want to borrow money from China to pay for Big Bird. He said that, and that was the most sensible thing I've heard in any of the debates. I mean, we have to make, we make choices all the time. You know, we look at overhead, we look at this, we look at that, you're making choices all the time. I don't think the government's there and has the, you know, the wherewithal or the leadership or the, you know, the Reagan, Tip O'Neill type of partisan discussions to make things happen in a more positive way. You know, the significant headwinds that are facing our GDP growth. You know, like I said, the consumer is doing well, but consumer debt, you know, mortgage debt, you know, the subprime debt, consumer debt went crazy to 2007. And in 2007, 2008, there was a statistic that I remember. The debt-to-income ratio, or the debt-to-income on the average consumer during the 1980s recession was 60 to 65% in the Reagan recession. In the subprime recession in 2008 and 2009, it was 125%. So that deleveraging going on in the world is what we're going through, and that's causing pain because as the consumer or the baby boomer deleverages, it's causing more, less purchasing and is a headwind to the economy. And, you know, as a person growing up in Jersey City, you know, one of my goals in life when I was 25 years old was to die $1 million in debt. Well, I got there in 2007. You know, tuitions, $1 million of tuitions with 4 kids. And now my goal in life is to get out of debt. And I'm working on it. And again, it's causing me gray hair, you know? So far, I'm 3 for 4 on the 4-year plan at college. My youngest, I don't know, he's working on it. He might ruin my streak. But when you look at things, you know, you got the delevering of households, you know, that's a headwind. Excess inventories of vacant homes will likely continue to restrain the pace of new residential construction and to limit housing and house and price appreciation. I know just recently there's been a little bit, you know, of good news on the housing starts. The impact of Sandy is going to certainly keep a lot of electricians and plumbers and construction workers busy. But at the end of the day, it's, you know, when you look at New Jersey, and then when it takes 3 years to go through a foreclosure process on sometimes a vacant home, you know, that's an artificial flaw in the economy. And what is the government doing? Similar to what they did in GM, right? They pick winners and losers. So the insurance companies and the bondholders were losers in GM. The unions and GM management and certain car dealerships and some were, you know, were closed, some were open. So you pick winners and losers. It's the crony capitalism of when government gets involved. Well, what's happening now? I have 2 kids that live in an apartment, one in New York, one in Hoboken. They'd be wonderful first-time home buyers. Can they buy that foreclosed unit? No, it's 3 years in the foreclosure process. So the people, the government again, is picking a winner. The people that maybe made a bad decision or bad things happen to good people, the government's saying, all right, you stay in your home for 3 years, don't pay your property taxes, don't pay insurance, live for free for 3 years. And then after 3 years, you can, you know, give up the keys. Well, maybe if they could have moved out of that, moved into an apartment, moved into another house, downsized, we would get that first-time home buyer back at the party. Because right now, the first-time home buyer is not at the party. All right, and think of the rates. Housing, purchasing a home has never been affordable. More affordable. 2.5%, I just signed up for a 2.5%, trying to get that $1 million of debt off my books. I had to sign up for a 2.5% 5-year ARM. All right, just have to have it. All right, I mean, I used to say we're getting our parents' rates, but my parents' rates in the 60s was 4%. They're even better than what the greatest generation had at these rates. And then I think, you know, consumer confidence, you know, whether it's the fiscal cliff or the European situation, you know, businesses, everyone's, I tell you, I talked to a lot of businesses. I think it's almost, you know, everyone's in neutral right now. I think, you know, when you look at even our forecast for next year, you know, now that, you know, we're a little bigger company, we're becoming, you know, our earnings have been up 20%, you know, every 3 of the 4 or 5 last year, consecutive years. This year, you know, we're not there. We need, with the interest rate environment, we need $750 million in loan production, net loan production, just to break even as a result of the net interest margin compression. So even before, you know, you run around, you know, you got to do, you know, 75 million, you know, 50 million, say 60 million a month net. And that's with the headwinds of a tremendous amount of prepayments on both the residential side and the commercial side. So to do that, you know, and if you want to grow net interest margin, and you want to grow, you know, 10, 15%, you're looking at about another 500 million to 700 million on top of that. Or you start cutting costs. I mean, 2 ways to manage income: grow the income line or manage costs. It's a lot more fun growing the income line. Forecast looking forward in 2012, 2013, and 2014. GDP, I think we're going to finish the year, I don't know, Jim will probably have more to say on it, but just under 2%. And that's nothing to write home about. I mean, that's the U.S. economy just doing nothing. That's not enough to create jobs or lower unemployment. The unemployment numbers, I don't even know how they figured them out now, but I don't think it's that great. It's 8%. It's going to hover around 8%. Maybe in 2013, it'll be down below 8%. 14, maybe into 7.5%, 7.6%. Again, business capital expenditures, consumer spending, and the monetary stimulus should continue to support a moderate recovery, while deleveraging, housing imbalances, and weak confidence levels will likely remain impediments to a robust expansion. We're looking at excess capacity and lower wage growth, but inflation should be relatively tame in that, hopefully a 1.5–2% target level. In the context of sub 2% economic growth, the unemployment rate will likely hover around 8% through the end of 2013. The risks to our forecast remained skewed to the downside, with Europe and the fiscal cliff being the big unknowns. Here in New Jersey, I think Sandy is the big factor. We've heard discussions from a contractor that the infrastructure down along the strip from Point Pleasant to Seaside, that the gas lines, the underground gas lines, have been compromised by salt water. So just imagine if they have to start ripping up Route 35 and putting in new gas lines, and what that's going to mean, 1, to the opportunity, but 2, to the cost and to the recovery, just getting people back in their homes. The New Jersey recession, at first I thought it wasn't as bad in 2008 and 2009, but now our unemployment is higher than the U.S. So we were below, when the recession just started, it was below the national averages. Now it's above. And it's a funny thing. It's going to be interesting to see how our governor handles it, because I think his campaign is going to be very similar to President Obama's, in that, hey, trust me, we're on a path, things are getting better. I got us out of Iraq, 2008, things were terrible, and things are steady. Well, when you look at the governor, I think his predecessor, people lost confidence in the government, the fiscal cliff that we were looking at in 2009, 2010, with the New Jersey, fiscal matters. We were on the verge. The budget was out of control. He kind of drew a line in the sand and put a stop to it, at least stop the bleeding. But on the other hand, when you look at the numbers, unemployment's worse. That's a fact in New Jersey over his 4-year tenure. But I think he stopped the triage. He stopped the bleeding. He got us at least on the right track. And the rhetoric has been more positive for business. The lieutenant governor's out there giving her a cell phone out to everyone. So, but at least the rhetoric is better. And I feel more positive, that consumer confidence, if we can start. The thing that gets me, and what we need to do, and some of the things that are important, are these public-private partnerships. We're just not out there doing enough of those things. We had some discussions with the Commissioner of Banking, regarding the Sandy relief, and I just got a note. We made a decision to make a grant to the Union County Economic Development Authority. So I think it wasn't a large amount of money. It was $250,000 to make loans to small businesses. And Tom Bracken, the president of the New Jersey Chamber, said, he sent me a nice note, said, yeah, I applaud what you're doing, but we got to get it done on a larger scale, but we can't seem to get the state, going. And that's the problem. Getting things done here in New Jersey, it seems to be cumbersome. And we have to, make things easier for businesses. to create, bottom line, to create jobs, create opportunities for people. So those things are some of the challenges that we have in trying to, take advantage of this Sandy factor and just get people back in their homes. One of the things that actually it's kind of amazing is that's impacting the economy here in New Jersey, and Jim will probably have better statistics on this, is the disappropriate reduction in state jobs and government jobs. Because the government is cutting back, because the current administration is trying to hold the line on expenses, the growth in state jobs is not there anymore. It's declining. The growth in government jobs is declining. So that's having an impact on the economy. Our housing market, because of the foreclosure process and other things, remains in distress. And we're seeing small contributions, from the manufacturing and energy production. Probably 4 or 5 years ago, we probably did a couple of solar deals. I haven't seen one probably in 2 years now. We did the largest rooftop, an $18 million solar deal over here in Edison at a refrigeration warehouse, and we haven't seen one come by our desk in 2 years. So I think some of that activity has certainly gone away. The positive factors here, and like I said earlier, New Jersey is a great place to do business. We have a great educational system, diversified economy. The service sector is strong, supporting New York City and Philadelphia, and being on the Northeast corridor. It's the wealthiest. It's either us or Connecticut as far as the wealth factor. It's the wealthiest state in the union, and so it's a great place. And for all the bankers in the room, we have a great banking system. All right, it's not Atlanta, it's not Georgia, it's not Florida, it's not Illinois, Michigan, Nevada, or California. There are probably 700 banks. You talked about the number of banks in the late 80s. It was 16,000 banks. Now there's 7,700. There's 111 banks headquartered in New Jersey, and I think we've had 2 failures. One in Elizabeth, one up in Bergen County. Very small banks. Depositors were not hurt. They were non-events. So the banking system is very, very strong here in New Jersey. Again, like the national economy, I think it's just going to be, at the end of the day, it's going to be more of the same. We're in the 3rd consecutive year, and there are, certainly, with all the fiscal cliff, there's serious concerns about the sustainability of the U.S. Recovery. So we're looking at, sluggish growth. With respect to monetary policy and interest rates, we keep saying they can't get any lower. Well, the German bond in June went negative, the 2-year bond. All right, the flight to quality during the last Spain or Greece crisis. We think Fed funds are going to stay low, priced in that 40 to 50 basis points through June of 15. We expect the zero interest rate policy will be extended by the Fed well into 2015. And there's really no real reason. There's no reason for it to go up over that period of time. If anything, if something happens in Greece and you have to flight to quality again, is that rates might come down further. And it's tough for a bank to make money in this environment. We can't lower interest rates. We were at Stifel Nichols at the New Jersey Bankers mid-year management program. He said if you're paying anything on deposits, it's too much. Because after the FDIC costs, your personnel costs, it's just not worth it. You can borrow cheaper right now. So who gets hurt in that type of environment? Are senior citizens that are relying on CDs and things like that. So where does it leave us? I'm going to be wrapping up. Right now, bankers in our industry, we've arrived at a tipping point, probably at a historical crossroads. The social and political and economic issues. It's almost, I talk about the baby boomers. My brother is about 63, 64, and I tell him, I said, anyone that was old enough to go to Woodstock screwed up this country. You know, it started with Clinton and Bush, you know, and those guys, you know, and really, when you think of it, we went from the greatest generation that fought World War II, got through the Depression, you know, changed the way this country, you know, lived, you know, built the best economy that the world has ever seen, to a company. What are we giving to our kids and our grandchildren? What are we giving them? The country's almost bankrupt. If you put the Medicare and the Social Security, you know, liabilities on the balance sheet, it's not a pretty picture. So I think, you know, we really need. I hope, you know, we were talking before the session about the fiscal cliff. I want to see a good decision, a bipartisan decision. You know, things were pretty good in 2000, 2001, you know, before the tax Bush cuts. You know, my wife loves Bush. I said, Trish, you know, you don't cut revenues and then go rebuild, you know, Louisiana after Katrina and fight 2 wars. And it just doesn't make any business sense. And add on to that the prescription plan for Medicare. I mean, you know, and the same thing, you know, I say sometimes, you know, with Governor Whitman. She did the same thing in the 90s. You know, this state was rolling in the 90s. What happened on Route 1, the corridor for, you know, for biotech? Where is that now? You know, we threw that away. We threw that out with the baby, you know, with the water. We threw the baby out with the wash water. I mean, that's gone. That's up in Massachusetts, out on the West Coast. We missed the golden opportunity because, you know, government, you know, did not do what was right, you know, for business here in New Jersey. So I guess finishing up, you know, I don't want to be too pessimistic, but I really think we need, you know, a good decisions down in Washington with the, you know, with the fiscal cliff. And if you look at, you know what Warren Buffett again says, don't bet against America. It's still certainly, you know, the greatest country in the world. And, you know, I wouldn't say don't bet against New Jersey. You know, I think with some good leadership that we're getting now from the governor, it is the best place to do business. You know, again, great locations, great transportation system, highly educated workforce, 14 great private colleges, great university system, and a diversified economy. So after that, I want to thank you and appreciate your time. Thank you very much. Chris?
Good morning. In your first part of your presentation, you talked about the job you had to improve the corporate culture in the bank and improve the sales philosophy. When you look at a bank to acquire, if you look at, do you also include looking at what their sales culture is and their corporate culture, and would that be enough to make you not interested in acquiring that bank?
Yes, and I can give you a great example, but I won't say it. And it's changed over a period of time. We looked at a bank. Actually, I'll give you the name because it was acquired anyway. It was Penn Federal, and we never bid on it, but they were too much like us at that time. So I believe they were bought by New York Community, and they were a bank that was very much like us. It was a residential lender and just CD-based, same thing. Now, on the other hand, our culture, we didn't have the confidence in our culture to change their culture at that point in time. So that was 4 or 5 years ago. Now, I think we could look at a similar institution, and we're confident that our culture could change them. So when we had the opportunity to look at someone's culture that it was too much like us, I said, we don't need to buy us. We got to buy someone better than us and help us, you know, do things better. So it is very important. Now I think we could buy someone that's not us and then instill our culture and do it in the kind of gentler way. We use the term evolution, not revolution, and treat people with respect. Because one thing I learned, you know, I've worked on probably 20 acquisitions with UJB, and that's one of the famous lies, you know, one of those famous lies, checks in the mail, is nothing will change after the merger. Everything changes after the merger. This logo here, our most recent one, the Greek Bank. Now, this Greek Bank was a well-run bank in Marathon. You know, had a great niche. I mean, You go to, I don't know if any of you guys get to Brooklyn and Queens, but I call Brooklyn and Queens Jersey City on steroids. It's just unbelievable. You know, Borough Park is Lakewood on steroids. It's just unbelievable what goes on there. And then every 5-7 blocks is a different community. And it's different markets. So every branch is almost a business unto itself. So there you got 3-4 cultures. And you got Bayside versus Astoria, and they're different cultures. So I guess when you look at that potential, the first thing the Marathon employees, when we met with their management team, said, can we keep our name? You know, do what New York Community does. You know, Atlantic Bank, a subsidiary of such and such. And these guys worked too hard on this little logo. It cost us $1 million, you know, changing that brand. And at the end of the day, you know, we're going to change the brand and change the name of the bank in January this year, 3 months. The only reason we didn't do it right away is we couldn't do the systems conversion at the date. The 5 other acquisitions we did, at the weekend we did the acquisition, we changed the signs, converted them to our systems, did everything else. This one, because of the size and the complexity, was a $900 million bank. We're doing it a little slower process. Okay, have a great day. Thank you very much.
We hope you enjoyed this presentation from the New Jersey Bank Marketing Association. For more information, visit njbankmarketing.com. This podcast series is available for sponsorship. If you're interested, get more information at bit.ly/content sponsorship. We produce these programs in the studios of Lubetkin Global Communications in Cherry Hill, New Jersey, on the web at lubetkin.net. For everyone at the New Jersey Bank Marketing Association, this is Steve Lubetkin. Thank you for being with us, and we'll see you out there on the net. Take good care.